It takes a brave man to stand in front of the freight train that is bank stocks these days, but that is exactly what Richard Staite did yesterday. In a note to clients, the Atlantic Equities analyst said the sell-off in Citigroup is overdone, and he reiterated his buy recommendation. Richard is one of the most accurate analysts on Citi, making him a Bloomberg best, and he's with us from London this morning. So, Richard, why is the selling overdone? We've been here before. We remember what 2008 was like, and in 2008, selling paid off. Why not this time?
You're right. Share prices have fallen a long way, but there are a lot of differences now with 2008. Citigroup has improved its balance sheet dramatically. It's got significantly more capital. But beyond that, the most important difference now is that US banks, including Citigroup, actually have really quite strong liquidity. They've been flooded with deposits over the past year. They've got rid of a lot of their higher risk loans. They're not suffering a problem in funding. And that was the key issue which people were concerned about in the last crisis, and we're just not seeing that now. So,
Richard, you know, in analyst speak, you reiterate your overweight rating. But in your opinion, is Citigroup, and maybe some of the other banks as well, based on what you just said, a screaming buy?
I think that Citigroup is a screaming buy. I think clearly the regulations and the new economic environment favours some banks over others. I would say we're still cautious on the pure investment banking model being pursued by Morgan Stanley and Goldman Sachs. However, I do believe the universal model, followed by the likes of JP Morgan and Citigroup, where you're combining a strong commercial and corporate bank with an investment banking business, where you have strong funding sources and retail deposits, I think that is a model which is going to continue into the future. And at this kind of valuation, where the shares of Citigroup are trading at half its tangible book value, is attractive at the moment.
Richard, I would like to bring in my colleague Stephanie Ruhle, who just joined us here at Bloomberg after almost 15 years at Deutsche Bank and Credit Suisse. Stephanie, why don't you, I know you've got a couple questions for Richard.
Richard, I understand on paper, Citibank, Morgan Stanley, Goldman, everyone looks significantly better than they did in 08, but this is about confidence. And how do these banks regain the confidence of the market so we can stop this vicious cycle?
Well, I mean, clearly confidence at the moment is all down to what happens in Europe. And clearly there are a lot of investors who have a view that there's going to be a pretty cataclysmic event in Europe. And obviously, to stand in that way, you've got to have European governments unite and support the banking industry and solve the sovereign debt problem.
But what about bank exposures? So Morgan Stanley and the others haven't really disclosed much. In fact, Morgan Stanley has said they don't even have exposure to France. What exactly do banks have to disclose right now? What have the regulators told them?
That's a very interesting subject. That's a question I get a lot from clients at the moment. Everybody is worried about the exposure of US banks to Europe. And initially this was to peripheral Europe, Greece, Spain, Italy. But more recently it's been concerns about exposure to French banks. And the problem is the disclosure there up until now has been quite weak. They've only been required to report their cross-border exposures on a gross basis, which looks quite bad for Morgan Stanley. The last reporting period, it was 39 billion to French banks. Now, management more recently said they've virtually got no exposure on a net basis. So it's this difference between gross and net, which is, I think, confusing people. I think that's the area where they need to improve disclosure, and I would hope you will get that in the next set of results coming up within the next 2 weeks. I'm sure this is going to be a real focus for analysts during those analyst conference calls.
Richard, are the banks able to fix their net exposure? Is it possible to hedge effectively enough that you can literally put it in a box and say it will be no more than X? And if so, should the banks, why don't I ask you that question first? Is it possible? And then I have a quick follow-up.
It is possible. For example, that 39 billion of exposure of Morgan Stanley, a lot of that could be repo lending, where the French bank would supply Morgan Stanley with high-quality collateral, probably US Treasuries, in return for lending cash to the French bank. Now, if the French bank doesn't repay, then the US bank or Morgan Stanley is holding very high quality collateral, and that's kind of not taken account of in these kind of numbers. So I think it's down to the banks to explain clearly how these arrangements work and really give people confidence that there isn't a huge amount of counterparty risk there, which has not been covered with collateral.
How about risk management? Historically, we've seen some poor risk management decisions out of a number of banks, Morgan Stanley, UBS, Bank of America, Citi. Do you think one of the reasons we've seen investors dumping stocks in the bank space is because they're worried about risk management?
I totally agree. I think that past track record is pretty critical at the moment. As you said, as we discussed previously, I mean, the actual numbers in terms of how their balance sheets look a lot better than 2008.
Since 08, can I ask, since 08, have you seen banks change their risk management practices to help the market feel more comfortable?
What we have seen is that they have been running down the higher risk assets as fast as they can during that period. For example, Citigroup has shed close to $500 billion of lower quality assets which were wholesale funded, and that was a real risk area for them previously. The offset has been clearly that this has put pressure on revenues and profitability, and people are concerned about the ongoing rates of return on equity for banks. But at least they do appear to have addressed a number of those riskier areas.
Richard, yesterday, a peer of yours, a colleague, if you will, Brad Hintz from Sanford Bernstein was here. We asked him about Goldman Sachs and Morgan Stanley specifically. What can they do? He said nothing. In 30 seconds, tell us what the banks can do. Is disclosure the key? Just telling investors more of what they're doing? Is that the key to getting them back on their feet in terms of the stock price at the very least?
I think they have to demonstrate they have a sustainable business model, and whether that's through disclosure or just a period of time, I don't know. But I mean, I think there is a question mark over Goldman and Morgan Stanley because it is not clear that those standalone banks can actually operate huge fixed income businesses in a wholesale funded manner. It's quite different for Citigroup, JP Morgan. And these kind of commercial and universal banks, I think they do have a more sustainable model, and I think that a period of time will demonstrate that to be the case.
Richard, good to see you here this morning. Thank you for joining us. Richard Staite, an analyst at Atlantic Equities. He's a Bloomberg Best on Citigroup, the stock he says is a screaming buy.